Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn Smith, co-author of The Great Crash of 2008 with Ross Garneau, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's head of investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy, and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. Yeah, so hello and welcome to our next instalment of Nucleus Insights. And today we're having a look at commodities, and we've entitled today's one Resource Business. I'm joined with me, of course, we've got Nucleus Wealth's Head of Strategy, David Llewellyn Smith. Hello, David.
Hi, Tim.
And Nucleus Wealth's Head of Investments, Damien Klassen. Hello to you, Damien.
Hi, Tim.
So let's jump into it. So agenda today, we're going to be looking at the state of play, a bit of a rundown of a snapshot of some graphs and on how things are looking thus far. Moving into trade wars, is it the grand bargain or an explosion for the US and China? We'll roll into iron ore, coal, metal and oil outlooks, and then head into what we see as the investment cycle and valuations at present, and of course, as always, finish up with the investment implications and how we look at these stocks on a day-to-day basis with everything we do at Nucleus Wealth. So with no further ado, we can jump in, and we'll kick off with demand from a macroeconomic standpoint. David, what have you got for us?
Yeah, well, so in the state of play, there are four dimensions to explore in terms of sort of inputs into commodity pricing. And the first and most important, I've actually listed these in terms of priority. The first and biggest is demand, or macro circumstances, and for most metals we can simply boil that down to China, since it consumes sort of 50% of most of them, or various sort of percentages around that mark. And there are many charts I could show you, but this one kind of aggregates everything as a leading indicator for Chinese demand, and that is, it's one we've showed many times before. It's broad credit, and this is the sort of key input into the Chinese construction economy. And as you can see, three major pulses since the GFC, which have all been very clearly matched by rises and falls in metals. And the most recent one that began in early 2016 is now running out of steam. So the demand outlook from China is not to come off quite as fast as it has before, post 2011 and then again in sort of 2014-15. It's a bit slower this time because some of that credit, the mix of that credit slowdown is a bit different. Some of it, what is slowing these days, is not quite so building centric.
Okay.
But nonetheless, it's still going to crimp building as we go forward. We've already seen that in the hard data, insofar as infrastructure is coming quite fast. Property market's holding up better, but will also slow. So
I might actually just jump, just to put a little bit of context behind that, is that China went from an economy in sort of 1990 that was consuming almost no resources and was a net exporter in plenty of these resources. So, or was actually what it was producing was it had more of that headed out for. There was more heading out of the country than what was headed in, and so. Sorry, just one sec. And then. And then what's happened is over that time period, China's actually grown a lot, and they've started this major Capex. So Capex has gone from a smaller part of their economy to over 50% of the economy, which is very different to most other countries. So we've hit this level of capital expenditure where they're building roads, bridges, new buildings, all that type of stuff. And that's just sucked in a huge amount of resources right around the world, and that's where we had this massive run up in resources from 2000 to 2008, on the back of not only US and European demand growing quite strongly, but China just going off the charts in terms of the amount. And then post that, a big weakness as the financial crisis hit, commodities really got smashed. And then what David said about those three pulses is since that period, we've seen three big spends by China in terms of the amount of debt that is put on to increase the Capex. And each time they've done that, commodity prices have boomed, and then followed as the credit has faded away, then it's busted. And from the chart he's got up there, just sort of showing that we're in the downward trend. And so it's very much reliant on that Chinese credit.
Sure. Okay, thank you. And so moving on to our second leg, and again, this is in order of importance. So some might be surprised that I haven't put supply there. In fact, I think the US dollar is come second in terms of commodity prices. There's two reasons for that. One, commodities are generally priced in US dollars, so the rise or fall of the dollar tends to affect the pricing of commodities, conversely. And the second dimension is the rise or the fall of the US dollar really determines monetary flows into emerging markets, including China, but much more broadly. And so if you get a rising US dollar, as we've seen since, roughly 2013, 14?
Yep, 2014.
There have obviously been ups and downs over that period, but the trend upwards, which has followed tightening US monetary policy or raising interest rates, has tended to suck capital out of emerging markets, and that means that their interest rates are rising as well. And so that slows the interest rate sensitive sectors in those economies, and they tend to be construction. So the US dollar therefore has an enormous impact on commodity demand, as well as directly upon prices. At the moment, if you think that the US dollar is rising as we do, then that's a second bearish indicator for the sort of top-down outlook for commodities. So the third leg of the state of play, if you can just shift that for me, guys, is supply. And there are various people around at the moment saying there are supply constraints in metals and bulk commodities and even oil. We basically think that's rubbish. It's certainly the case that after the super cycle and the various shakeouts we've seen in commodities that have matched those Chinese credit pulses, that some supply has been shut down, the very high cost stuff. But if you look at this chart, this one's only up to 2012 and the boom kept going after that. This is minerals investment projects worldwide, and we'll show you a chart later in the presentation that puts this into broader historical context. But the boom was enormous, the investment boom was enormous, and it was a huge capacity build out right across the metals and bulk commodities complex. And that remains basically the same today. There was a supply shock, as Damo was describing, when China first kind of entered the WTO and started building a lot more stuff, and we were all short of commodities. But over the subsequent decade, there was just enormous investment in capacity and supply. And those, as I say, some of the high-cost stuff has been shut in, but if you get an uptick in a price, it can be reopened really quickly. You don't have to rebuild mines or railways or ports. All of that stuff in the supply chain has now been filled out. And so it's very easy for supply to come back into the market. So there are some commodities where there's still clear oversupply, but I can't find a shortage just about anywhere in any of the industrial metals or bulks.
Okay.
So that's another reason basically to be neutral, if not bearish.
Sure thing. And I guess with all that build up in supply, it leads us into inventories.
Yeah, and so this is the fourth leg of commodities pricing, which is inventories, and this one's a much more cyclical component. That is when you have the first three influences interacting in certain ways to either push up prices or lower prices, then inventories play a role in exaggerating that cycle. So, if you've got, what tends to happen is you'll have a boom in demand and, everybody furiously digs up the dirt and ships it out.
Yep.
Speculators pile in and start to hoard the commodities and store them up, just to make money. And they sit on them and then sell them later. Mm-hmm. And so you get what you'll see in this chart, which is the big inventory builds that tend to match the underlying cycles. And basically today, we've just been, we had a huge inventory build into, the big Chinese post-GFC credit splurge right up until 2011. Then as it tightened credit over the subsequent 4 years, you can see the inventories were run down, and that exaggerates price falls because you've just got idle capacity or idle stuff just being thrown into the market.
Yep. And so what David means by the exaggeration is that quite often the build of inventories from speculators makes everything worse because you short a commodity, somebody's busy building a mine and all this type of stuff, and so they haven't actually got the commodity on yet. Yep. The speculators are all stockpiling this stuff, and so the people who actually need it have to keep bidding the price up to try and get it. Yep. And then all of a sudden the mines come on board, and the speculators are like, right, we need to get rid of our inventories because we don't want to get caught, holding these things forever. And so then they start selling, and you get the double effect of new mines coming on plus the
roll off of the
speculator at the same time.
Yeah.
But I think as a general rule, commodities do have there is a role for speculators and for that within the market, and what they're basically doing is
rent seeking.
No, it's basically an insurance, basically. I mean, and I think that's where most commodities have this thing about that you're buying futures and you're getting this roll, and there's a whole asset class of buying commodity futures. And the idea for me behind that is that what that's basically doing is there are producers out there who want to hedge their production. They've got these big costs, and they want to make sure they don't want to lose money. And so people are stepping in and buying the commodities for insurance purposes to help those guys defray their future costs and stuff like that, which is a good thing, for that, because it does help supply and helps continuity and all that type of stuff. But it can also work the other way, as David said, talking here, is where the speculation becomes rampant, and then you end up
the multiplier effect,
exacerbating these cycles rather than the speculators being there as a helpful hedge or a sort of insurance for producers.
Yeah. So this chart is basically all of the financial hoarders, if you like, and as you can see, we've just over the last 2 years, as we've had this Chinese rebound, they've all gone nuts and stored up a whole lot of stuff again, just as we're heading into the peak. That runs up to the first quarter of this year, and so some of that may actually be starting to come off now. I could show you a number of different charts in different commodities, but they all look very similar. There's plenty of inventory.
Okay, sure thing.
So what that means is the four sort of key inputs into commodity pricing right now are bearish.
Okay.
So that's the state of play. So that brings us into our second agenda item, which is trade wars. So what we've got here is a slowing China, that's trying to deal with its accumulated debt problem. We have a tightening Federal Reserve in the US, with the US booming. That's giving you a strong US dollar. And that's already making life quite difficult for China because, as I discussed earlier, when it comes to the US dollar rising, then you tend to see domestic tightening, especially around construction in all these emerging markets and including China, as just part of this sort of typical cycle where we are in the cycle. But then we've overlaid that now with a trade war. And that's added this extra dimension where, all sorts of uncertainties and what have you, but in effect, China's trade account is now being attacked by the US, while its capital account is already under pressure from the Federal Reserve. And this is making Chinese macro decision-making very difficult. They don't have a lot of good options for dealing with this to prevent it from becoming, from making their domestic slowdown worse. At the moment, what we're seeing them do, or allow at least, is a falling yuan. So as all of the capital that we've talked about comes out of emerging markets, including China, and heads back to the US, chasing the returns, Chinese authorities, in their wisdom, have decided to let that happen. They have the option of stalling it through selling some US currency reserves and various ways of trying to prevent it from being too fast, but at the moment they're simply letting the yuan fall. Now that may sound stimulatory, and it is in the short term, but it's then obviously tips into the whole trade war problem where they're getting more competitive, just as Donald Trump's telling them that he wants them to export less. And so, they're in a kind of Chinese finger trap, if you like, at that point.
And the other thing to note as well is that, one of the big structural imbalances in China is that there's too much investment spending and not enough, because they can buy more from other countries and things like that. So that generally helps push things in the right direction. The more the yuan appreciates, whereas a falling yuan actually ends up going consumer spending less, and which means you need to then spend more on infrastructure projects or things like that to keep the economy ticking over. Yeah.
So they've got this falling yuan then, which is exacerbating, the underlying credit tightening. They're trying to address that, with some easing in various things, reserve ratio requirements and various other tools. But most of that is just liquidity support. It's not really going to trigger more credit. And so, the way they've got things running at the moment, their slowdown's going to intensify. Now, have they got other options? As I said, they could support the yuan by selling some of their US dollar forex reserves, but that actually tends to tighten local credit as well through various monetary mechanisms. As well as that, if the market gets a sniff that China is going to run out of forex reserves, then the falling yuan becomes a self-fulfilling prophecy, and that way lies financial crisis. So they have to be very careful about how much and when. They can't really respond to Trump much with tariffs. They're kind of outgunned on that front as well. So, to me, as Damo says, the answer is really fiscal for them. They're going to have to spend some more money domestically. It's very difficult for them to do it with monetary policy for all the reasons we've just discussed. If they were to cut interest rates, the yuan will crash as the Fed tightens, so that's out. And so, they may simply have to let property slow and maybe stimulate for some more infrastructure. But even on that front, if they go that way, they've got to find the debt somewhere, and it may not be all that easy even to do it fiscally. So it's a difficult situation that is making, what was a very deliberate slowdown by China, potentially a lot worse when it's overlaid with the trade war.
Okay, yeah, sure. We've got a quick question here from a viewer. Does the US equity boom survive a China slowdown?
Yes, well, that's really the million-dollar question that I don't have an answer to, but we will endeavour to get some way to the answer to that through as we sort of unfold this presentation. But I would say that the key to that at this stage is oil. We went through a sort of a dry run of this process in 2015-16 when the Fed first started hiking rates and China saw big capital outflow and went through a big slowdown very deliberate one that kind of got hijacked again by Fed tightening. On that occasion, the contagion that ran from Chinese slowing back into the US equity market was oil.
Right.
Because it coincided with the US shale boom that went completely bust, and that took down some of the high yield debt markets, which US shale relies upon for funding, and that really started to shake up US markets. And it took the US equity market down and actually led to the solution for the problem in the short term, which was the Fed more or less got together with the PBOC, the Chinese central bank, and the Fed agreed to pause its tightening, while kind of giving China the headroom to cut interest rates, which is what happened in early 2016, and is part of why we got this new wave of Chinese credit, as well as a strong yuan over that period. So to me, the key commodity and transmission mechanism from any Chinese slowdown into the US is oil, because once oil starts to crash, then it really damages a lot of stuff in the US these days. It's not the US of old where, good growth was associated with low oil. It's actually the other way around now, because oil production has become so key to US activity.
Yep.
And it's really supportive to income growth. It's a big driver of wage growth in the US. And so, that's what happened in 2015. Oil crashed, shale came off, wages stalled, the Fed stopped.
Yeah. And it's worth noting that it was an implicit or tacit agreement between the Fed and the PBOC to sort that out. And now under, different leadership in the US, not only at the Fed, but also at the, also on the trade front and the president is there will they be so accommodating? And I think my answer is, well, not without getting something out of it. And so I think he's probably more than happy to do something, but he's going to need some help on whether it be Iran or North Korea or whatever.
The central banks are nominally
golf courses.
They're nominally independent, but I think a realist would accept that it's become more difficult for the two to coordinate on a save. And the other factor now, of course, is if you accept oil as the key transmission mechanism here, or sort of channel of contagion, is OPEC, which is actively managing oil prices. There's no shortage of oil anywhere. In fact, there's heaps of it. But OPEC is very deliberately manipulating it to keep it higher. So, that sustains these pressures on China for longer, when in 2015 we saw them come off quite fast because oil did.
Yeah, right. Yep, sure.
So my best answer, that's a very long-winded way of answering the question. But I would say that the equity market will be more supported for longer now. The other element to this is US activity is much stronger, and EPS growth is off the chart thanks to this huge deficit spending and the tax cuts. So ultimately, you would expect if China went into crisis, it would pull down the US. But the point, I guess, to make is that the crisis this time has there's a lot more props to growth in the US, which means actually ultimately that the risks to China are much higher than they were in 2015.
Okay.
And so we're quite conservatively placed for exactly that reason in terms of our equity holders.
Yeah, we are. I mean, we've still got exposure to the US, but yes, I mean, we've cut back a lot. But there's two ways of looking at this. You can still see some late cycle reasonable gains, because so long as oil holds up and these metals fall, that's going to actually cap the sell-off in the US Treasury market, and that's going to be very supportive to US equity valuations. And so, we've been running this notion that you can have what we were calling a reverse decoupling, where you'd have emerging markets slowing because China was slowing, but having oil help hold up the US and developed market returns for longer than usual.
Okay.
So that's why we've hung in there whilst also positioning ourselves conservatively.
Okay, good answer. Just one last question too before we jump across into the types of companies and give Damien a chance to have a bat. I've got one here. Given that everything we have in this world has either been mined or grown, then how can it be that the total market cap of all the world's mining companies is not much higher than any of Amazon, Apple or Google on a singular basis? I realise that it all gets back to profitability and predictability, but it all seems bizarre to me. So is this a past earnings versus future earnings sort of equation, or?
Nah, it's commodity
Okay.
versus non-commodity products. Really,
Okay.
In the end, is that there's in many of these metals, and let's take iron ore or coal for example, there's bucket loads of this stuff. In various countries and at certain prices, it all becomes economic to pull out of the ground, and so you simply cannot charge the prices that you charge higher prices. Well, that's fine. Somebody else will start up a something next door or down the street, and so the companies just can't make, because nobody really cares whether, as long as it's similar grade, nobody really cares where it came from.
Where it comes from, okay.
Brazilian-
Unlike a Facebook or a Google experience, which can only come from a parent company.
One place,
Okay,
yeah.
interesting.
And
Scarcity pricing, basically.
Yep. Okay. All right. Fantastic.
So I'll just run through some outlooks then.
Okay.
Before I pass over to Damo.
Yeah, sure.
What all of that boils down to then, for our outlooks on prices, for the key prices for Australia are the bulk commodities, of course. I think I've still got a $60 average price on iron ore through the second half of the year. If some of this trade war stuff gets a little bit more out of hand, that's going to be too high. So that's a base case, not a risk case. But they will definitely be tilted towards falls, the further into the second half that we get. And I expect iron ore to continue to fall next year. Beyond sort of 12 months, you're then into speculation about how this cycle ends. I mean, that's probably not useful.
Okay.
But I would certainly expect iron ore to be falling over the next 12 months. And so if we say 60 in the second half of this year, then I'd be looking at 55 in the first half of next year, and just, you'll see spikes down as well. Iron ore has a very weak period in September, October. I wouldn't be at all surprised to see $50 then.
Okay.
Coke and coal, I would expect to just track iron ore. It's been very strong this year, but it generally just they move hand in glove. I don't think that's about to change. Thermal coal has been absolutely crazy of late. I'm a little bit bewildered about where that's going. It's so far above where the Chinese have kind of benchmarked it to be that I'm just a bit uncertain about what's going to happen. But I saw something in the press recently regarding India. Is there sort of some? India's playing a bit of a role in both coals, but not so that the price should be where it is. But if the bulks, the other two steel-related bulks go, I'd be surprised if thermal didn't track them down to in some measure.
Mm-hmm.
The industrial metals, I think they're all basically past their post 2015 Chinese stimulus peaks.
Mm-hmm.
I'd expect them all to fall as well, and then oil, is more questionable because it's much more artificial and difficult to predict. There's no such thing as an oil bear. Everyone in that market is forever bullish. But where we are right now, it's hard to see it going much higher unless there's some further geopolitical problem, either Venezuela really coming apart,
Mm-hmm.
or Libya coming apart. OPEC is going to pump some more. So where we are between $70 and $80 looks really rich to us, and in fact is sowing its own demise because it's generating such a huge shale burn in the US.
And makes batteries and electric cars more, a couple of years earlier, that they look attractive.
Okay.
So.
Yep. All right. Wonderful. No worries. Thanks for that, Dave. And we'll jump across into some more company-focused sides of the resources game with Damien Klassen?
Yeah, I just want to. This is just a relatively quick run through of like how I guess I look at the sector in terms of individual companies and what to invest in within that sector. Is that I sort of look, there's four types of companies that I consider, and the first one is exploration companies, and they don't really sit within my universe, but certainly they're out there in the investment universe, and priced more as a lottery ticket in terms of your most companies, the median company, so loses money and you just waste the capital, and then every now and again one company makes such a huge return that everyone else sort of bundles in and says, hey, look at that, that somebody just made 1,000% return in that company, in company X, let me go and buy these 10 other companies that are going to lose you money.
Yep. Okay.
So then you get onto these companies that are under construction, and so these are ones that have found something. So if you find something, then you go and raise the capital and you set up all the operations and things like that. And again, this is sort of outside my universe, which is we generally deal with the large caps, but there's a whole bunch of companies in there under which what you're dealing with is really this operational risk and funding risk and things like that. So you sort of make returns for the explorations more like a lottery ticket. For the under construction is more of a risk of operations and funding. And then finally, you get into the actual, the actual producers of companies, and I break them pretty clearly up into two sets. You've either got your marginal producers, and these are the guys that are going to make plenty of money when commodity prices are high, and they're going to lose money when prices are low, and quite possibly go to business when prices are low.
An example of one of those in Australia, just for listeners out there.
Oh, look, we saw also the Atlas Irons, and your, some of those. There was a bunch of the some of those iron ones that went broke recently. BCI.
I can't remember them now.
Yeah, they're all off there.
Atlas is a good example. It's somehow managed to hang on until it's sold off its infrastructure effectively now.
Okay, sure.
Yeah. Yep. And so they're your ones which and so the idea behind those ones is they might have costs of let's say we're talking about iron ore. They might have costs of $70 or $80 in terms of their production, and so what that means is when the price is $60, they're losing money. Mm-hmm. But when the price is $120, they go from losing money to making plenty of money.
Okay.
Whereas the guys who have costs that are sort of more like $20, they go from making a $30 per ton profit to a $70 or $80 per ton profit, which is great. They might have doubled their profit, but it's not like it's gone from a negative to a massive positive, or it's not like in some of the other cases, where your profit might be 10,000 times higher because you're a very marginal producer. And then finally, your tier one guys who basically range between being profitable or barely profitable, I guess, at traditional levels, to extremely profitable when we go through these booms and then sort of back again. So the baseline is not actually making that much money, but you make plenty of money when you do go through the booms.
Okay, sure thing. And then mining economics.
Yeah, so the basically a mine consists of 5 different elements. So there's what you have to do is you've got to move some dirt is the first step, and so it costs sort of roughly $2 to move a ton of dirt in US dollars, and if you're big, you can get that down with economies of scale to maybe $1. So the first thing is how big is the operation, and you got to move dirt around. Then you go how much ore do you actually have, and how much dirt do you have to move off the top to get to the ore. Okay. So the question of overburden. So in terms of iron ore, it's called a strip ratio. You're basically moving somewhere between about 1 ton of dirt to get to your ore to maybe 4 or 5 tons of dirt to get to your ore.
Okay.
Coal, you can go a bit more. You can probably go up to 10. And after that, you go underground. So basically, once it's deep enough that I've got to move, 50 tons of dirt just to get to 1 ton of ore, well, now it's no longer profitable to move the dirt. It's actually, I just dig underground and my costs get higher.
Okay.
In terms of underground costs, you're probably talking, depending upon what you're doing, you can do there's some bulk underground type costs that you can, if you're pulling out things like coal, where you might be able to get costs down to maybe $30 a ton to do on a bulk basis. But if you're doing more traditional mining ones, you're probably $50 to $100 a ton in terms of the under. And it can go much higher if you need to get very complicated. So in South Africa, for example, there's a lot of very, very deep gold that's very, very hard to get out. The sort of guys are basically doing it with jackhammers by hand, and but they get plenty of gold, and so it's worth. It might cost them $200 a ton or something like that to move the dirt, but it's so valuable that they'll get in there and do it. So we've got the cost to move the ton of dirt. You've got how much till you get to your ore, or how much you got to you cost to pull it out. The big issue is how much metal you've actually got in that ore, and so that varies. And this really depends. This really is what makes a top tier mine versus a bottom tier mine. So if you're talking about something like gold, some of the South African ones can have 10 or 15 grams per ton, which sounds incredibly tiny in terms of, and it is 15 grams of gold out for every ton of dirt that you're moving, but there's plenty of ones in Australia and other countries that have got 1 or 2 grams per ton.
Wow.
So if you're somebody who can pull out 10 grams per ton, you're
5 times better than
the guys, or 10 times better than the guys pulling out 1 gram per ton.
Yep.
And so in terms of the actual costs, that's really where it all boils down to is if I'm getting 10 times the revenue that David is, well, the cost part, whether it costs me 20% more or 30% more or 50% more to produce it is by the by. I'm getting 10 times the revenue, so it doesn't really matter.
Sure.
So
and you've got there obviously another strong point for Australia is iron ore. My old patch in the Pilbara, it was known for very high Fe.
Yeah, yep, that's right. Look, it's the iron ore there is relatively high grade. So that's iron ore itself is widely dispersed amongst the world. It's just that we've got some very high grade stuff that's quite close to the surface, so that's quite easy to you don't have to move much dirt to get to it. Yep. It's quite high grade once you've got it. Dig it out and you ship it off to wherever it goes. So that's the next part is the distance to travel. So now this basically doesn't matter for the big commodities. So you're talking, for the non-bulk commodities, you're talking about, if you're sending stuff by train, you're probably about $20 per 1,000 kilometers plus some loading costs.
Okay.
So,
per ton.
Yep. Yeah. So, if you're looking at iron ore, then iron ore's priced at sort of $60 per ton, and you're moving it, 300 or 400 kilometers in the Pilbara. So costing you $10 that's all right. I can handle that because it's $10 compared to my $60 price or $70 price for iron ore. That's not too bad. When you're talking about copper's valued in the thousands of dollars. So $10 here, $20 there doesn't matter.
Sure.
Gold is thousands of dollars per ounce of gold. Forget about tons. So the gold transport cost doesn't matter. A lot of these places helicopter it out because it's just doesn't matter the value of the mineral versus that. So the distance to travel and the transport cost really only matters for the bulks.
Okay.
And then there's some milling cost type things. So basically what I'm getting to with this is, so we've set up this mine where we're basically going, these things are pretty mechanical, and companies really don't have that much control over where they sit on the cost curve. So it's not like you can say, I've got a mine run by some small exploration company, small producer, and I'm going to bring in all these BHP execs, and all of a sudden this is going to be a top tier mine. That's not the case. That might be in other industries. That can be the case. We're a company that's having problems producing something. So you're a Tesla trying to produce cars, and you're having a lot of production problems. But if you ship that across to a Toyota or someone like that, they could come in and fix a lot of the problems, and they've got lots of experience, and you end up being a top tier producer. That's not the case in mining. You are what you've got in the ground. Okay. And you can only sort of play up and down the ground. 20-30% difference in costs up and down.
And that's it.
The net effect is, what have you got on the ground? Yep. How far is it to get it to market? What percentage of metal? There's not a lot you can control.
Okay, sure thing. And then thinking about decisions that they make.
Investment decisions, yep. Yeah. So the next thing is then saying, well, most companies don't have very many mines. They might have, if you're talking big ones like your BHPs and stuff like that, they've got 4 or 5 really big mines around the place. A lot of small ones. But making a decision on whether to go ahead or not go ahead in some of the smaller mines makes almost no difference to the overall valuation of the company.
Okay.
The decision about whether to spend 10, 20, 30 billion dollars on a major new project, that makes a huge difference.
Okay.
Now, companies only make these decisions once or twice every 5 years. And the thing is, these decisions, you're probably dealing with a different manager. If you make one decision every 5 years, your CEO quite often has changed in that period. Quite often, half your board would have changed. Do companies really have, do these mining companies really have a structural advantage in terms of being able to say, these companies make really good decisions. I can invest in this company because it's a high quality, because I know they're going to make good decisions. Whereas you say, well, I don't know, because it's going to be different management. I
was just going to say that. So obviously, as someone who's trying to grade a company's future performance, you can't use the metrics of the past, essentially, because the people making the decisions may be looking at something else or have a different.
Yeah. Well, you can use it on terms of the mines by saying, look, the mines are what they are. You've got, it's hard to change the level of the mine.
Yep.
I guess what I'm coming back to is saying, well, can they introduce a new mine? You say, well, maybe they can. Maybe they can make a cracking investment decision, but they make these so often, so rarely that we really don't know whether one company is better than another company at making these decisions. The other thing is they have very little control over the outcome. So if you're a gold miner with, say, your costs of $1,300 an ounce, and you're in 2007, and you're making these decisions, and you put this thing on, and you're making $100 an ounce, and next thing you know, the prices go up to $1,800, and all of a sudden you're a hero because you've gone from making $100 an ounce to making $500 an ounce. You've made 5 times better return than what you thought, and the next thing you know, the price crashes down to under $1,300. You're losing money. The board's got no control over that. Like, they've made a decision to go, well, yes, we know it. $1,300. If we've invested $1,300, we'll make $100 an ounce. That's worth doing. But the actual price swings are so volatile that it's very hard to then. They've got so little control over it. You can't really judge them by that. Whereas an industrial company can say, yes, we think we've got demand for our product. We're going to open a new factory or open a new country, and we're going to do this, and they can make a decision. You can actually say, yes, the decision they made and the outcome is actually was related. Whereas with mining companies, it's saying, well, they thought they could build this. They did. They got on time, and everything was right. But they got the wrong part of the cycle, and so
that's it.
And so let's come back in 15 years and they can get to a better.
Yep.
With a completely new CEO. So,
fire away, Dave. Yep.
I'll just make an example of what Damo's talking about. We saw recently, which was, you had Rio and BHP pumping out iron ore like crazy up until the end of 2015 in a very deliberate strategy to not necessarily lower the price, but certainly take advantage of their low costs of production and force the high cost guys out. And that was during a period where demand was waning and the price was falling anyway, and so they were chasing market share. Then we had management changes, and suddenly everybody wanted to talk about supply constraint,
right?
And only drip feeding some of their new capacity into the market, actively holding capacity off the market to hold the price up, and that coincided with Chinese stimulus, and so it worked quite well. But at a certain stage, management's going to change again, and we simply don't know what their view will be. That they may return to the market share strategy, or they may not. And again, when demand starts to fall away, the whole notion of holding supply off the market doesn't make quite as much sense, because your prices are falling anyway, and you're actively keeping competitors in the market by trying to hold up the price. So there is that interplay, where management over the long run can make all sorts of really different decisions that affect the valuations.
And once you get outside the major metals, in some of the minor ones, and what you find in some of those ones is there sometimes there are very, very big reserves. So let's say we took a mineral sands or something like that. There's some very, very big reserves of some of these things where it's basically you're basically scraping sand off the beach in the right place and turning into various things. There's some, and so what you need is really, really big operations for those, because you want to make sure that I've got this. I'm just digging it off the beach. You can do that anywhere. I need to get my economies of scale right down. And so in some of those cases, you basically go, well, if one of my competitors opens up this new mine which they've got sitting there ready to go, they just haven't developed it, they will wipe out any profits for the next 10 years for everyone in that sector, because the mine is going to be so big that everyone's got to cop it.
Yep.
And so if I've got a smallish one, if I make my decision to go ahead with that, and my competitor doesn't do it, that's a fantastic decision.
Payday. Yep.
If I make my decision to go ahead with it, and my competitor also makes the decision to go ahead, I'm wiped out.
Lose.
Yeah. And so, so you're not really in control of your own destiny, is where I'm getting to for all these things. So what that comes back to for me is making macro decisions about the sector.
Okay, sure thing. And so we'll jump across now into some quants. So we've got
So we've come back to saying, look, we'd like to make macro decisions about the sector, and then how do we do it? How do we go and run these quant factors? So traditionally with quant, you try and especially in our stuff, we're trying to say, well, what's a quality stock and what's a value stock?
Okay.
So within quality, we're looking for stability of earnings, and we're looking for margin of safety and all these things like that. Now, you don't get that in any of this sector. So generally speaking, the quality is quite low. But what tends to happen is your BHPs and your Rios look a lot better because they do have more stable earnings, and some of the more marginal ones like your Fortescues have just, the volatility of their earnings is massive in terms of those types of things. So so from a quality perspective, we've got one. We can sort of separate them, but what you find is when prices are going up, it's the bad quality stocks that really go up for that reason we spoke about. That they're the ones that will double, triple, quadruple in when prices are going up. Mm-hmm. The flip side is they're the ones that are fall 50, 75% when the prices are headed down. The other thing with quant factors is most of the valuation type factors don't work well for resources companies.
Right.
So there's an old adage in Australia is, you buy it on a high PE and you sell it on a low PE. Which is the fact of saying, well, these stocks are on a low PE generally at the end of the cycle because they're earning so much money, and whereas it flips around when everyone thinks no one's been spending any money on in Capex for years, well, that's when you actually want to do it.
Okay.
So what I tend to use the quant for is, one is to identify which are the high cost and low cost competitors, so which ones are the high quality and low quality, and then looking back to Capex and running this sort of more of a macro screen about saying, well, if Capex is on your side, then let's go ahead. And in terms of analyst forecasts, I've got a badly, unfortunately I don't have a better quality slide than this one, but I've got a slide up there which is showing the earnings per share on average from mining companies and versus some forecasts at the peak. And so what it's showing is that companies earning sort of maybe $5 to $10 per share for, from 1975 all the way up to 2005 effectively. Yep. And then all of a sudden it took off, and the prices, so nobody spent anything on Capex for that whole period, and then all of a sudden prices took off and these companies earned a fortune, and they made their earnings up to sort of over $100, $110, $120. Mm-hmm. Analysts then promptly forecasted that earnings were going to $600 basically. Wow. So at the peak of the cycle, analysts had this thing going to the moon. And so, effectively what you're saying was a company that used to earn $10 was now, I'm forecasting it's going to earn $600 because, it's gone from 10 to 120. So of course it's going to go from 120 to 600.
That's right. Yeah.
And in the meanwhile, it fell back down. And so the question for in terms of do I look at analyst forecast is saying, look, no, I don't. And I don't. I think the shorter term analyst forecasts are generally quite good, but the anything in the long term for analyst forecast is pretty much useless because it all comes down to your commodity price forecasts. Analysts in the resources sector are good at forecasting costs and production and things like that. They're terrible at forecasting, and I'm not saying it's their fault. Usually it's not even them; it's somebody else in a different department. But human beings in general are bad at forecasting commodity prices. And
that stands to reason because there's just so much at play, isn't there, sitting behind that commodity price, as we've covered, previous slides.
Yeah. Plus you've got the currencies as well, playing around with it as well.
Okay, sure thing.
And so what that means in terms of Capex, so Capex is what we're looking for. If you pull back to a long-term chart of Capex, so I've just got, this is the Australian Capex, which is a pretty good proxy for world Capex. So basically, used to be under 2% in terms of GDP. So Capex to GDP was sort of ran at sort of 1.5%-ish. And then every now and again it would spike to sort of 3%. Basically every 15 to 20 years you see this spike. And for those that can't see the graph, so we had one in sort of the early 70s, another one in sort of mid 80s, a little one at the end of in sort of 99, 2000. Then we had this sort of down bit, which coincided with China, taking off, and then all of a sudden we had this big, massive boom. So basically, nobody was building anything for sort of pretty much from the mid 80s out to the early 2000s. So capacity really ran down, and then we had this massive boom, 3 times the size of any other boom we'd seen before, and we're just coming off the end of that now.
Yep.
So, and people are talking about the next mining boom, and that's where we're on the path, and David's talking about the capacity side as a big picture thing. Look, we've just been through the biggest mine, 3 times the size of any other mining boom we've ever seen. The cycles are typically 15 to 20 years long, and we're talking about, a sort of 3 or 4 year turnaround, and next thing we know, off we go to the next cycle. Seems unlikely.
Okay.
Or put it another way, it's a joke.
Okay. Thanks, Dave.
So there might be certain minerals where it might happen, where there'll be shortages or big mines run out and things like that. But as the complex as a whole, it's very unlikely that we're going to see anything like the Capex, and it's much more likely we're going to see a 10-15 year period of consolidation and not much.
Okay, sure thing.
There is a reason for Capex to be slightly higher. That we are getting deeper mines. There is more automation. But the flip side is there's less people employed in these. So basically what you're sort of doing is, in a way, you're trading off higher upfront costs for lower ongoing costs. And so that Capex could easily be structurally higher now than what it used to be, but we're not expecting these massive booms for
potentially
some time.
won't have the inflationary pressures of wage growth and employment and all the rest of it as well. Okay, sure thing. So we'll crack on with our implications for investment as always, where we wrap up today's webinar and fold that into how we view stocks and investments at Nucleus Wealth. So, David?
Sure. Well, I've covered a lot of this already, but to wrap it up, definitely seen bulk commodities continue to fall for the rest of the year. As I say, I don't think it'll crash unless the trade war stuff really intensifies and paints China into a nasty corner.
Okay.
But their deleveraging is they've actually done a very good job of it so far, and it's going to continue into next year as the base case. So I'd see bulks falling. One thing I will add to what I said earlier about iron ore is I do think that the grade pricing differentials that have appeared in the last few years are going to continue. I think that is structural, but we'll still see the entire price deck fall.
Okay.
So, the average price, if you're looking at it from the perspective of the Australian budget or something, will still be falling materially. Same with the other bulks. Rising in US inflation and dollar in the short term. There is a bit of a cliff edge on this around 2020 when some of their deficit spending starts to roll off. But until then, you do have considerable kind of momentum behind EPS growth to support US stocks. So, it's at a certain point, yes, China's going to slow so much that it'll take down the US as we discussed, but we still don't think we're quite there yet. And then the falling Australian dollar, of course. At the moment, there's a lot of debate around what drives the dollar, but the two main factors are the carry trade based around interest rates and interest rate differentials on that front. The Aussie's under a lot of pressure, and that's going to increase as the Fed tightens and the RBA doesn't. And in fact, I still think it's going to have to cut in the next 12 months. So that gives you a kind of context of quite intense downward pressure on the currency. And if you look at the long-term relationship between those spreads and the dollar, they're incredibly strong. But right now they're very stretched, and that's because commodity prices are still quite high. And so if the commodity prices come off further as we expect, then that stretched rubber band of yield spreads is going to snap back, and the Aussie's going to fall.
Okay.
Quite a bit. And finally, their increased Chinese or reduced capital flow. Well, I mean, at the moment with the yuan falling, with the domestic economy slowing and the stock market dropping, this is the context in which we saw a lot of capital flight out of China in 2015 that triggered a lot of capital inflows into Australian property. We don't think that's going to happen again. China's got a lot more capital controls to stop it happening. Plus, a lot of that at the time was driven by some of the anti-corruption programs that were going on, and that has really kind of died away as well. So if you're your average on the take kind of middle class Chinese bureaucrat that's stacked away a few beans, you may not be as determined to get them offshore as you once were. And in fact, there's probably a higher risk that because there's so much pressure on the yuan, that they'll be forced to tighten the capital controls even further. In which case, we'll see the reverse, which is more money flowing out of Australian property, less money flowing in, and some possible outflows as firms who had plans to develop or bought assets are forced to sell.
Okay.
And so I actually think that's the more likely of the two scenarios in terms of capital flows out of this.
Okay, very good. On that note, we will jump into some information about how you can encapsulate some of the themes that you've heard today in your portfolio with Nucleus Wealth. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. So I hope you enjoyed today's presentation. I certainly did. And if you like that one, you'll certainly love the next one. So our next instalment of Nucleus Insights is called Good Defense is the Best Offense. And what we'll be doing in that presentation is running through how we select counter-cyclical stocks is one method, and a range of other methods for helping to create some stability in client portfolios and help offset when, obviously, when various sectors move around as they do, to smooth performance and ease volatility in a client's portfolio. So same bat time, same bat channel, which is next Thursday, the 12:30 Australian Eastern Standard Time. If you'd like to head over to proton.nucleuswealth.com to register your interest for that, and we can keep you abreast of any movements and information for that webinar. As always, we are available on iTunes and wherever your quality podcasts are sold on Android. Podcast Addict is one. All you need to do is search for Nucleus Insights or Nucleus Wealth, and you'll find our array of webinars and podcasts there for your listening pleasure. Just finally, thanks for attending. As always, we will be sending out our survey for anyone to give us some feedback on how we've gone today. And also, if you'd like, you can drop in a couple of topics for us to research and present to you going forward. So on that note, thanks very much for joining us, and we'll catch you at the next one. Cheers.